Let's talk about adjusting entries. The first type of entry, we have different kinds. The first type of entry that we're going to talk about are prepaid expenses. This is something that we've paid for in advance and we're going to consume over a period of time, and at that time it'll become an expense. A prepaid expense starts out as an asset for its classification in the beginning. And as we consume that asset, it becomes an expense at the end. An example of a prepaid expense would be some of the supplies that you purchase for college. Some of that would be pencils, highlighters, your notebooks, things like that that you use over a period of time. So whenever you first purchase those pencils and pens and highlighters, it's going to be an asset. It's an asset because essentially you could technically sell those back to the company or sell it to somebody else as not ever have been used. But once you start using them, the ink goes out of the pens, the lead is out of the pencils, the eraser's gone, you've used up all the paper, so you've consumed that. And then it becomes an expense of that period. So whenever you first buy pens and pencils for a semester, it's an asset. After the end of the semester and you've used all of those, it becomes an expense. So an example of an adjusting entry, we would have first recorded this as supplies for $10, and then we purchased it with cash. Both the supply and the cash account are classified as an asset. Once we've consumed those supplies, we're going to change it to an expense. We're going to debit this expense account, supplies expense. I'm going to abbreviate EXP for expense. And then we're going to reduce the amount of supplies we have on hand. We reduce an asset account by crediting it. And let's just say we only used $5 worth. So if we were drawing a T account, just to check the balance in the supply account, we started out with $10, so I'm going to put it on the debit or left side, and then we consume those supplies, $5 worth. I'm going to put that on the credit or the right side. Our balance in the supply account is a debit of $5. Let's move on to unearned revenues. Unearned revenue is just something simply that you haven't earned yet. Somebody might pay you in advance for doing a job. Let's say that you own a construction business and you're going to build a house for somebody and you require a 10% deposit. You haven't done anything yet, but you've earned that money, or you've received some money. So when you first receive the money, you're going to debit the cash account because cash is coming into your pocket. Assets increase on the debit side, and let's just say $10,000 is their deposit. You're going to credit unearned revenue. Unearned revenue is classified as a liability because you haven't done anything to earn that money. I'm going to abbreviate. You haven't done anything to earn that money that they gave you yet. So technically, if you never complete the house or whatever kind of construction job that they've assigned for you to do, you would owe that money back to them. Remember, our unearned revenue or our liability accounts means we owe money to someone else. Once you've started completing that, at some point along the way, you've earned that $10,000. The adjusting entry would be to debit or reverse the unearned revenue account. Let's go ahead and use for the whole $10,000. We have a credit here and a debit here for the same amount, so that's going to cancel each other out, and we no longer have a balance in the unearned revenue, and we're going to classify it as earned revenue. Let's just call it fees earned. This side is our adjusting entries. These are the entries that we use whenever we first receive the money or purchase something. Moving on to accrued revenues and accrued expenses. We can kind of talk about both of those at the same time. Accrued might be a new word for most of you. All it simply means is earned. You've earned these revenues now. Okay? You've earned these expenses. So for example, we might have billed somebody. They put something on account with us when they bought something, and we billed them an invoice. We technically haven't received any money, so we certainly can't debit the cash account, but what we can do once we get all of our invoices together and say, hey, this money, we've already earned this money. So we're going to credit the revenue account. Let me draw it on this side. We haven't received anything yet. So our adjusting entry is going to be a credit to the fees earned account. And let's say that's $500. Can you think of what account we need to debit in order to recognize that we're going to be receiving this money in the future? If you said accounts receivable, that's exactly correct. I'm going to abbreviate. So we've got a debit to an asset account, accounts receivable, saying that we expect to receive that money in the future, and our revenue account is fees earned for that $500. Before, since we hadn't received any money, we hadn't made any entries, and this is our adjusting entry. We're going to recognize that we have now earned that revenue.